We've talked a lot about accounts payable and notes payable, but there are other current liabilities too. Let's spend a little time talking about some of them. When you buy something at the store, do you only pay for that item? For example, if you are purchasing something for $10, are you going to pay $10 for it? No, you have to pay sales tax on it too, right? If the sales tax is 7%, then you will pay a total of $10.70. This sales tax is collected by the business you purchased the item from, but it is not theirs to keep. They are collecting it for a government agency and then sending it to them. That 70 cents will go into a current liability account and will then be paid to the government agency once a month. The entry for that sale would include a debit to cash for $10.70, a credit to sales revenue for $10, and a credit to sales tax payable for 70 cents. We've talked about deferred revenues or unearned revenues when we did adjusting entries. This time, let's talk about a specific unearned revenue: gift cards. Ever bought a gift card or received one as a gift? When someone purchases a gift card, the company has not provided a good or a service yet. The gift card is an advance payment to the company for future services or products. Until the gift card is used, the company has not earned any income. When a customer purchases a gift card, the company would debit cash and credit unearned revenue. When the gift card is used, the company can then debit unearned revenue and credit a revenue account. If companies issue gift cards with an expiration date, they would recognize any unused portion in revenue when those gift cards have expired. Contingencies are a type of liability that has some level of uncertainty. They represent a potential future payment. For example, your company may be in the midst of a lawsuit and you may have to pay a settlement amount. Whether we record a contingency or not depends on the likelihood of the future event and the ability to estimate the payment amount. The likelihood of a contingency having to be paid could be probable, reasonably possible, or remote. The ability to estimate is that you can or cannot estimate the amount. A contingency is only recorded if it is both probable and can be estimated. One of the more common contingencies is warranties. Ever bought an electronic device and been asked if you would like to purchase the warranty for it? That's what we're talking about. A warranty is something purchased by a client to protect against possible damage to or defect of the product. Warranties as a whole are deemed probable, as most companies that sell warranties on their products have a history of customers redeeming or using those warranties. Warranties are also able to be estimated. While the company may not know the exact amount each warranty might cost them, they can reasonably estimate warranties based on past history and industry practice. When a warranty is purchased, we would debit warranty expense and credit warranty liability. If a warranty is used or a warranty claim made and repairs done, the company would debit warranty liability and credit cash or accounts payable. One other current liability actually deals with long-term liabilities. Let's say we have a 10-year note on our books. This note is paid in annual installment payments. That means when we make up our financial statements at the end of each year, we will owe one payment within the next fiscal year. Therefore, 1 year's principal would need to be reclassified as a current liability, as it would be paid within the next 1 year. The rest of the amount due on the note would remain in long-term liabilities. I hope you've enjoyed getting to know a few more of the liability crew.